So today's video is going to be very, very simple. I can take questions at the end of it. I'm going to wind up giving a cheat sheet at the end on what to do with the moving averages. I was asked a lot about this, but this is going to be a really very simple lesson today, or I think it should be really simple and quick. But I want to get to the point of it. The point is to how to learn how to use some of these techniques that we're going through in an effective manner. So let's just drill into this, and let's just start with something as simplistic as the SPY. So what we're going to do is we are going to overlay 3 moving averages, all right? And I'm going to give a ton of examples today, but I just want to overlay 3 moving averages. And then I'm going to point out what these 3 moving averages are so that people can have an understanding of this, and you can review this later. Now, you're going to see the 5-day moving average. Okay, this is a 15-minute chart. So all we're doing here is taking a 3-day moving average, a 5-day moving average, okay, an 8-day moving average, and we're overlaying them on a shorter time frame chart. And that's really what I really think is pertinent. I really do. I really think it's pertinent to understand why would you do it this way. So why are you looking at this on a 15-minute chart? Why aren't you looking at this on a daily chart with a 3, a 5, and an 8, right? And there's a reason for it. Now, the reason is because clarity. So what do I mean by clarity? I mean that it becomes increasingly obvious if you break down a level and understand it. So for example, the entire day of that bar that we just saw on the SPY is this, all these candlesticks within candlesticks, right? So if we understand that that daily candlestick is made up of this candlestick, well, that really tells me what's going on under the hood. It really tells me how the cake was made. Let's say it like that, right? So if you think about it from that perspective, it adds value. Now, if you think about it from that focal point, that is how you're going to benefit from it, what you're going to do is then see how to make money off of it. Now, how are we going to do that? We're going to do that by utilizing these moving averages. Now, what I would suggest is the following, okay? You never, ever really want to be doing any kind of day trade at all, unless you're above the 3-day moving average, okay? You never want to be doing a day trade when you have a declining 3-day moving average, okay? Especially if you're new. You don't want to be trying to pick this off. It's very, very difficult. Now, there are 2 things to realize about this moving average. Number 1, the 3-day is in green, okay? And let me just break this down again. You can see that that is denoted by 78. If you take 78 with the 15, 6.5 hours in a day, multiply it by 3, that is how we got to that number. So any questions about that, I'm more than happy to answer. But I really just want to get into the crux of it so that we can do examples. So if you have a 3-day moving average and you are below that 3-day moving average, okay, then you want to stay out of the way for a day trade, okay? If you write that down and you use that as one of your rules, you will find that your day trades, all of a sudden you do a lot better, okay? So it's a 3-day moving average, and that really helps you determine intraday where you can benefit the most, right? And it's not really rocket science. I'm just going to take a look at the SPY here. You can see when we broke that 3-day moving average, we went to the 5. Here's the 3-day again. When it broke above it, you went right to the 5, right? When you broke that to the downside, that was it, okay? Never came back, never 1 bar above it, never 1 bar above it when it broke, okay? After you got over it, pulled back, tested, and broke out, what does it become? It becomes support, right? So resistance and support the same exact way. So one of the key things that you're going to want to focus on is the 3-day moving average if you're doing intraday trading. So in other words, if you're trying to trade during the day, you should have a 3-day moving average outlined on a 15-minute chart, okay? You should have a 3-day moving average, right, over a 15-minute chart. We're going to use the 5-day in a moment and the 8 as well, but we're going to understand exactly what we're trying to do. We're trying to figure out a system that can make money for anybody. So in other words, depending upon your time frame is how you're going to want to utilize these, but you're going to use these as guides. Okay. These are, if you go back and use a strategy tester, like let's say you use a strategy tester like here, and you implement a trade and you back test what I'm about to show you or what we're going over, your probability of trades will go up dramatically. All right. And this is really the stuff that I like going over and really like teaching, because it actually can add value and you can go out on your own. And I know that not everybody wants to go out on their own and find their own ideas. I get it. But if you're interested in that kind of thing, this is going to get you there. Now, as you see this 3-day moving average, and we know what it's about, there are levels to this 3-day moving average. So number one, if you cross above the 3-day moving average, but you're pointing down, okay, that is not as good of a sign as if you are pointing up. Okay. So were you pointing, let's just go through the SPY, for example, were you pointing up here? No, broke down, rejected the 5. Okay. Here, if you look at this line very closely, and again, this is a chart that I would have set up on my screen that I'd be looking at during the day. I look at this during the day, just FYI, especially in this market. This, what I'm showing right now, works best. Okay. What I'm saying works best in a trading market. In a runaway breakaway market, if you're using this strategy, you're going to get frustrated because you're going to get a lot of failed breakdowns. But for what we're dealing with right now for trading in this type of tumultuous time, this is excellent to help you navigate it. So here's your 3-day. All right. Now you see how all of a sudden what happens here? It turns. Well, why does that 3-day turn there? Well, we're going to get into that. Okay. This is 78, right? So if we know that's 78, then we know that every single one of these bars is roughly, we're just going to say it's like 1.12%, something along those lines, right? So if we understand what this line is, then we know that when this bar comes out, right, this low comes out and is replaced by something over here, well, we know that this line is going to pick up, right? So theoretically, as long as you are above the average of what's going on back here, you can predict that this line is going to start peaking up. When you get good at that, you already know that this is going to happen, okay? Because you can calculate it out just by looking at this, right? And just say, you know what, if we just stay right here, this is going to go higher. And that's exactly what happens here, right? So now we can get more into that, more advanced later, but now you have the 3, the 3's pointing up. Once this 3 is over, everything above you is gravy as far as a trade for intraday. You should feel comfortable placing intraday trades on whatever that is. I'm just using the SPY. It does not matter what it is. We can pull up Tesla, okay? It's completely irrelevant to what it is, all right? Break down here, break down here, break down here, right? You can see that. Here's your 3-day moving average. Breaks it, points down, gets up over it, doesn't hold, down, 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 right? What happens down here? Down. Where does it start curling up? Right here. What is the trade that worked the best? When the 3-day started pointing up. I mean, you can't really get any better of a read than that held. Now, if you're in a trade for the 3-day, and this is how I would do it, okay? So in other words, let's say that you want to bottom fish, that you're looking at the market and the market pulled back, right? So this is the way I'm doing this class today is very informative, but I'm doing it so that it's applicable, so that you could actually utilize what I'm going to teach today. So it's not going to be a ton of notes. You're going to have to take notes yourself. All right. So I just think it's better for me to teach it this way. So as you break out and you cross, now that intraday trade, if you were trying to stay in it for a longer period of time, you could stay in that trade when you get above the 5-day. The 5-day SMA would be your next resistance level, okay? I started using this in like the late 90s. Somebody showed me how to do this. It was an institutional trader. Okay. In markets, when you are going sideways or in bear markets, this will save you a litany of money. If you just say, I'm not going to swing trade or hold anything overnight, right? Anything overnight that is below the 5-day, the amount of money that you'll save is staggering, right? Just something that simplistic. So keep that in mind, okay? Now, the 5 days, the simple calculation, and anyone can do this. I use open, high, low, close, which is 4. I don't use just the close for these lines. I wanted to know the exact range and average of each bar. Remember, each 15-minute bar here is made up of 15 one-minute bars. So I want to know what's going on inside there, okay? Now, we have that 130 line. Same principle applies, but this applies more to a trade that you might be looking at for 1 to 2, or let's say 1 to 3 days, all right? So you have your 3-day line, and your 3-day line is going to be, right, we just talked about this, right? So let me just show you this again so you get it and point this out. Green, 3-day, yellow, 5-day, purple, 8-day. So now you're coming down, right, on your 5. Okay, this is where you broke on your 5. When you're sloping down and you break above it, it does not hold the same weight as when you are sloping up and break above it. Okay, so when you're doing something like this, and people will remember this, or they won't remember it, but see how you're rolling right here on that level? Okay, that becomes an issue. So you're pointing down, you're breaking above it, but you're failing and going right through it again. You're popping over it, and then you're failing. So let's say that you like this idea because you're above the 3. So you bought this for an intraday trade. You pop above the 5, and then you break below the 5 the next day. So in other words, you bought it on the close over this 3-day break. You come into your day, the 5 days right here, and then you just get below that 5-day. You just blow it out, right? If you're just a day trader and you want the overnight hold, you just sell right into that, okay? Now, the 5-day will start to curl up. 1 to 3 days is really where you're starting to look at a 5-day. I would say more 1 to 2. But once you get above that 5-day and this 3 starts curling, you're going to get your second signal, okay? And this is a signal that people trade off of. This is a signal that only people use, okay? And that's what I think is super important, okay? So what do I mean by that? When people start throwing in the, hold on one second here. Let me just walk through this so I explain this properly, because I'm going to go off on a tangent. When you see this cross here, this is all people use. Okay? This is all they will use. Now, let me just walk you through what I mean by that. Let's get rid of the 8 for a minute. And let's focus on the 3 and the 5. Okay, so they will just play the cross. That's all they're going to do. Okay, here's your cross. Okay, so again, the green is 3. The yellow is 5. This is a very simple thing that anybody can do. Okay, so here you are. You have a little pattern that you like. You break this little trend line right here. Okay, and now you have a day trade on, right? You like the fact that it broke this. You saw something that you wanted to get involved in. So you break above this 3 and you're like, I'm going to give this a try for a day trade. I'm going to use that as my low. It breaks out. It gets above the 5. You stay in the trade for a period of time. Over the course of the day, by 1:30, you have a cross. You're like, oh, I have a swing trade buy signal. So let me just explain that again. Your 3 crosses your 5. So now this is basically something that could turn into a swing trade. Okay. And what you're going to do with that as it scales out is a completely different story. But what they'll do is they'll just buy that. They'll just outright just print that. Okay. And then what some people will actually do is not sell until it crosses. Now, I don't agree with that, but that's what some people will do. But this is just an outright, I need to get out signal. And if you just look at something like that, just to kind of put it in perspective, even in this kind of tumultuous market, if this was your buy and your sell signal, okay, you can kind of see here, let's just draw it from that buy signal to that sell signal, which would be right here, okay? You lost about $3 on the trade if you did that, right? That's not what I'm suggesting. What I'm suggesting is that you use them as buy signals and you use them as sell signals. What I would do with them and how I would utilize them so that you could make money is, if I'm in a short-term trade and it does this, you might want to consider holding on to it. So that question that everybody asked me at the end of the day, hey, are you holding this? You can answer that question for yourself. How would you, I mean, you're more than welcome to ask. But where I'm going with this is you could actually look at this yourself and go, am I above the 3-day? Am I above the 5-day? Is there a 3-5 cross? Where am I right now in my trade? then you now have an objective way of determining the high degree of probability of that trade working. Okay. If you're in that trade and that trade is under a 3-day moving average, all right? And if that trade is over a 3-day moving average, then you know where you're at. If you're over a 5-day moving average, right, and you don't have the cross yet, you know where you're at. If you have the cross, you know that there's a high degree of probability that this trade is going to continue to push higher. You know that if you're long here and you're hoping and you're now below the 3 that's declining and the 5, you now know that you are hoping, right? You already know that. You know you have a problem, right? So maybe you wouldn't have held here. Maybe you would have avoided this or this, but nevertheless, that's something that needs to be considered. So now you have a 3-5 cross that you can add to your arsenal. These are simple moving averages. So now you can see the difference between where this line is going to be, okay, and where my line, right, is. So you can see that difference very clearly, right? Okay. And that's really pertinent. So you understand where you are in the order and you understand why that's significant. Hopefully you understand why that's significant, right? So let me just walk through that again. Okay. The exponential moving average is not on. Let me just clean this up and make this super simple. There's your 5-day SMA. Okay. Here's your 5-day EMA. Okay. Who gave you the first signal? Right? Who gave the first signal? So when you look at it from that perspective, right, you're going to want to be in there. Now, devil's advocate, just so you can understand the perspective here, right? Who gave you your first signal? Who gave you your first signal, right? I mean, you can see it over and over again. So this is one example. Sometimes it's a little closer, but this is just a 5-day. That's why you use an SMA versus an EMA. Okay, I want the actual data. I want the average of where these people are. This is an average. You don't need to skew an average. That's how I look at it. Maybe I'm old school in my thinking. That's how I view the world. Now, in regards to the 5-day and 3-day cross, when you get out, there are a myriad of other tools that I have given you to get out, right, and trim. Some of those tools involve things like RSI, and we've gone through those ad nauseum, and I'm not going to do it today, but you could pretty much tell that if you wanted to get out, you know, when you're up here at like 90, it's giving you that opportunity, okay, to trim if you want to, right? So there are things that we can discuss at later dates, but what I'm trying to focus on here is, should you stay in a trade? Should you not stay in a trade? What does the trade look like? How can you determine whether or not you should execute that trade? How you can figure out, should you hold that trade overnight? You can do all of those things with these moving averages, all of them with these moving averages. Okay. So now you have a 3-5 cross and you know how that works. You know what those crosses are. You know that that is one trigger. You know that another trigger is simply popping above it. So let me just give you a great example of this. So this was a trade that we actually did in the room, and this was part of the tools that I utilized to do that trade, okay? So right here, we flipped the 3-day for the first time, okay? Right here, right? And then we made that higher high. So I looked at that and said, this is a great scalp trade. Why? I'm watching this wick. I'm looking at a 15-minute chart. So I've got a couple things that are lining up perfectly here. I'm over the wick. We know wicks are what? Price rejection. Flipping the wick and flipping the 3-day is substantially more important, right, to me than just simply flipping the wick, right? So right here, and let's just walk through why. Okay, right here, you have flipped the wick right here, right? But you're not above the 3-day. Look how far off you are. So you know that you have work to do, right? And what happens? A day later was the trade. Not that day, right? So it's important to understand where you are if you are day trading and where your 3-day moving average is. I can't stress it enough. On this particular trade, when we popped over, that was it. The trade was on, traded it up. It was a scalp trade. That's all this was. Why is it a scalp trade? Because I used the 3-day moving average to make that decision. By the end of the day, we were not over the 5. You understand where we're at. I don't want the risk of the next day. Trade's over, we lock in what we lock in, and we move on with our lives, okay? Trade sets up again. This time you now have a 3-5 cross, right? So now you could make another more informed decision about what you're going to do right here, okay, when this happens. For me, I kind of liked it, but on Friday, but the problem with the trade was on Friday, you needed to stay in the trade the entire time, okay, to make any money, and all your move really happened at here. But I do like the way it held in here at the end of the day. So that is a 3-5 cross and how to use them on day trades. Now let's just take, it doesn't really matter. Let's just take, I guess we'll take Tesla again, and then I'll take your trading ideas and we can implement them in the strategy and go from there. So now I'm going to leave the 3, the 5, and the 8 on. And you should be able to color code those again and know exactly what they are. So by this time, you should already know when to use a 3-day, whether or not you should stay in a trade overnight. You should know about a 3-5 cross and what they mean. You should understand the slope of the line. All that should be understood by now. If it's not, we can go over it again, and you can tell me how to explain it a little bit better. Now, you're going to have an 8-day. That's a 208 open, high, low, close. 208 open, high, low, close. Let's go through this. All right. See where it stops? See where you are? Okay. That's just the way it is. You're just going to have to, there's not much you're going to be able to do about that. Now, here's your level right here. Okay. What happens when you got above it? Rejection. That was it. It was a clear signal. And then you got a signal the whole way down. So if you were looking for a short, let's say that you're looking at shorting this pop, and you're going, well, I've got a declining 8-day. I pop over the 8-day and I break down. I break down over the 5. I break down over the 3. Okay. There's no reason that if you're in this short, right? And let me just walk you through this again. If you're in this short and in 15 minutes you're sliding, or 30 minutes you're sliding through these levels, there is very little to do, right? Now, you might try to play these little bounces, which is sometimes I'll try to play them to get back to these lines and revert to a mean. Sometimes that makes more sense. Sometimes that works. Sometimes it does not. So what you need to do is you need to focus on that and see if that's something you want to participate in. But if you were to ask yourself a very simple question back here, should I stay in these puts? The answer is a resounding, I broke the 8, I broke the 5, or I broke the 3, I broke the 5. Yes. All right. When will I cover? Well, what is the path of least resistance to when this trade is no longer even valid? Okay. So the trade would be no longer even valid. When would be the first time if you're going to use something as simplistic as this, right? Well, once I got above the 3-day and closed above the 3-day for the first time, that might be something that I would consider. So here you are breaking the 8-day and using that level and that reversal pattern plus this pattern to determine that you should be short, right? So now you're using your 8-day. You broke below your, right? You broke below your 3, you broke below your 5. What is your first indication that you're going to exit? If you want to exit, that's your first indication right there, highlighted, breaking above the 3-day. So if you're here overnight, it's 3 o'clock, right? 3:15. 3:30, and you're short and you get a close like this, okay, then you might say, you know what, I made my money. I'm going to get out of this trade, right? Let's say you entered here, just for sake of argument, right? And you go, I made my money. I'm going to get out of this trade. Okay. There's a 6-day trade where you made 20 points just by utilizing that simple system. Now, come through this way, turning through the 3 crosses the 5. 3's pointing up, right? Here's your signal for your short-term trade. Here is your signal for your swing trade. What are you doing? Your 5 is crossing your 8. They're both pointing up, okay? So swing trade can be placed on right here. So you'll remember this, and there were people in the room. If you go look at September 7th's live video, and I do appreciate all the feedback while we're on the topic. I'm going to ask a bunch of questions today, later. But at the end of this, but I do appreciate all the feedback with the live alerts and how to make it better for everybody that is working. And it's a work in progress, but I think we'll have it straightened out this week. But for the people that were on the call and the live alerts, we had people that were buying Tesla right into here. Now I put the alerts out there somewhere around here. You have to go back. I have to go back and take a look at where it was exactly, but in this area, we started looking at it, and there were people that were playing it. Why? You bounced off the 3, the 5. So the people that wanted to play it, I'm like, just watch how you act at that 8-day, and you can see the battle. But as that battle's going on, the 8-day moving average, what's happening, right? So you have this battle going on right here, okay? And as that battle's continuing, all you're doing is building the 3 and the 5 up. So the longer you stay up here and fight that line, the higher degree of probability that you're going to break. I'm going to say that again because I know I'm throwing a lot out there. The longer you stay testing that line, the higher the degree of probability you're going to break. And that works on the upside as well as the downside, right? The more times that you hit a line and fail, hit a line and fail, hit a line and fail, the more chances that you're going to fail. Right? That's just the way that it works. So, and that's just because the averages are going to pull you down or the averages are going to take you up. So once you have that flip right in here, that's a signal. That's a clear indication and that's a clear buy signal to try that trade. You'll notice one thing about these trades very clearly. Okay. You know, within the first 15 minutes, whether or not that trade's going to work. Why is this system effective and what I'm doing? Because if you listen to what I'm saying right now, you can greatly reduce your drawdown. If you listen to what I'm saying right now, you can greatly reduce your drawdown. If you can reduce your drawdown, and I can tell for the trading room, especially newer traders, that's 70% of your battle. So if you can reduce that drawdown, okay, that's what you want to focus on. Now, how would you reduce it? This is very simple trading. Here's your wedge line. Here, you're above the 8 for the first time. You break above this huge flag. Trades on. This is your stop, this bar right here. This level right here could then be moved to the stop. You never got stopped out. The best trades never even test those levels. Okay. And off you go. Now you have another signal here that you could utilize, and then you would not sell until you saw something like that over here. Let me find one that makes more sense than that because that doesn't really make sense. So now you just have a cross. You don't really have any down crosses right now. That's kind of interesting. I wonder why. There's got to be one out there. Apple was a disaster. No, never really got there. So even Apple's above the 8-day now. Interesting. So that's really where I'm at with the crosses and how to utilize them. The slopes matter the same exact way. I would like to take some questions, and I do want to show a quick cheat sheet. That's it in a nutshell. I was going to keep it short and sweet, and hopefully you have me. Just let me know that you do. But I was going to keep it short and sweet so that I could take questions. And this is not something that is overly, should not be overly complicated. Let me go back to this, put the screen up for a moment and go from there. But I want to show you this cheat sheet that I put together. I got asked a lot about this. So I'm going to pull up a cheat sheet and then I'm just going to take questions. This is a very simple technique. And sometimes, you know, I like the more advanced stuff, and I think it's from doing it from a period of time. I like talking about, like, you know, the cloud and looking, and I use this a lot. I really do. I use this a lot. I actually use all the parts of it, but it gives you a signal. And as you get better, what you'll do is you'll overlay these. So like you'll go, oh, well, not only am I above the 3 and the 5, I'm above the cloud. Maybe I should pay attention to this. And the cloud all of a sudden is not hitting lows, right? So that's kind of interesting too. There's something to this. I'm going off on a tangent, but let me just point this out to you. There's something to this, that this line is here, okay? And this line is here, right? We would call that a divergence, right? That becomes increasingly clear. It's another signal, but I like the complex. I think it's from just trading for a long period of time, but this is very simplistic and easy to use. And if you follow what I just explained, you will save a lot of money on your stops, and you will save a lot of money on how to utilize this. So I would suggest that for the month of September, which should be a great trading month, we are setting up for a great trading month. Okay. You can say it coming. So some people are definitely going to be on the wrong side of this. You can see it coming. And I think that utilizing something as simplistic like this could really help you, either using the crosses or using these levels during the day to help you assess your positions and risk on your positions during the day. Now let's go to this cheat sheet and then we'll go from there. So very simple. Okay. You have a cheat sheet. Okay. This is it. You might want to screenshot it. I can put it wherever you like. I can drop it in the room. All right. So for me, 3 days, intraday trading. If you're doing a day trade and you're not above the 3-day moving average, the chance of your day trade working are significantly diminished. So I'm going to repeat that. Intraday levels. If you are not above the 3-day moving average and you are doing a day trade on the long side, your chances of that day trade working are significantly diminished. If you're doing a day trade and you are above the 5-day moving average, 1 to 2, 1 to 3 days. Okay. I'm going to use above and below. If you're below it, they're shorts. If they're right below it, they're shorts. If it's above it, it's not. Okay. These are demarcation lines to determine how you should be positioned. Okay. If you're in a trade and that trade is not working and it is below the 3-day moving average, you have to ask yourself some questions. If you're down in that trade and you're below the 3-day moving average, you have to ask yourself if this is something you want to stay in or not stay in. Now, if you're position trading or it's something that's in the newsletter that we're trying to hold for weeks or months, you really can't look at that because you're going to go a little nutty. Now, on the day trades and the swing trades, you can. Now, the 8-day moving average is for swing trade levels. Swing trade levels to me, 2 to 6 days, roughly, definitely more than overnight. And then you are looking at something as simplistic. Absolutely, Charles, I'll throw it in the room. And then you are looking at something as simplistic as swing trade levels. Swing trades, 2 to 6 days, 2 to 6 weeks, roughly is there. Okay. Bulls and bears. Okay. Who's in charge? Bull or bear? If you are above the 21-day moving average, these are all simple moving averages. If you are above the 21-day moving average, okay, you are in a bull control. If you are below the 21-day moving average, you are in a bear control. So when you are buying something for a position trade below the 21-day moving average, and you're buying it for a position or a swing trade, you are at a disadvantage. It does not mean that it cannot work. It just means you're at a disadvantage. Okay. So 50-day, and you'll notice this, and we're going to look at some examples. Institutional sponsorship. Do I have institutional sponsorship or am I losing institutional sponsorship? So the reason that the number one trades that are working right now, and we can go look at some of these examples. Okay, I've got the institutional sponsorship and I have the day trade levels working for some stocks. The stocks that is working for right now are the ones that are moving the most. Okay, I have institutional sponsorship, which means I have a base, and then I have the day traders that are coming in and buying those names. Now, 200-day moving average is your last stand for the bulls or the bears. Okay. When you get above that moving average or below that moving average, all right, that tells you that's your last stand on position trades. That tells you if they've given up on the name or not given up on the name. All right. That's how you need to look at that. Now, in regards to slope matters just as much as position. So slope matters just as much as position. If you are sloping down, okay, if you are sloping down, but you're above, you have to take that into account that there is a higher degree of probability that you're going to roll back down. Doesn't mean that you're going to. The longer that you stay above the line, the slope will start to change over time. As that slope starts to change, you're going to want to stay in the trade, but you'll know by how it's acting at that level. So for example, if you take a look at Tesla and we go and look at this particular level right here, okay, you'll see how the 8 is pointing down. So you don't know if it's going to hold, right? Like you just don't know if that's going to hold. Then you flip up and then you push higher. Okay. When you do this flip right here, that's what you're looking for. Now, if you do something like that, then you just want to be involved with it. You want to stay with that trade. These numbers are going up. Now, if you're looking at this on a daily basis, and I'm just going to click off of these, and we're just going to I'll give you an example of this cheat sheet on like a 200, 21 and a 5, and we'll just make this an 8. So now let's go and take a look at this. Okay, so do I have institutional sponsorship? Yes, I do. Right? And we have Wix below. So we have institutional sponsorship. Do I have the day traders involved? Yes. I do. Okay. Are we starting to get some of the swing traders involved? Yes, we are. Okay. Who's in charge? The Bears are still in charge here, so this could easily roll, right? Because you're under 21. Break above the 21. Who's in control right now? Well, if we close above it, the Bulls are in control of Tesla. Okay, that's how you think about it. Am I above the 200-day? Yes, I am. Now we can see that you're battling that 200-day and that it's still declining, but this is a combination of 200 days. If this just stays here, that will start to point up actually. So when you see something like this, you just want to see that higher high and see it push. But this shows who's in charge. So that's really what I wanted to go over today. I know it was very simplistic for some people, and I know it's new for others, but I think keeping it simple is probably the best thing to do right now, considering the circumstances. And I know tensions are extremely high, and people are stressed because of how much the market's fluctuating, which is relevant. I actually think it's an interesting time to trade, quite frankly, because the amount of volatility and the amount of people that are betting for the market to drop versus whether or not it does drop, I think that there's going to be a big skew there. But that's just my opinion. So that's all I have. All I wanted to go over. If you want me to put up ideas or you have questions, I am here to answer them. I'm going to pull this up because it's most likely going to be in the newsletter, but I just want to show you this. So this is pins, and you can see the battle where Elliott Management just keeps buying the name, and then you rally over them, right? Pull back down, test that 50. So when you get rid of this, let's just clean this up really quickly here. But when you get rid of these and you understand those levels and on that little cheat sheet, here you are right at the 50. Do you have institutional sponsorship? The answer is yes. Now you do. Who's in charge right now? Right. That was a really big close. I didn't think we'd get it. But we're getting that. And there's a couple of things going on with this that I think are really pertinent. Like you've not been above this since you broke. So it's been over a year since you've been above the 200-day moving average. So this is actually setting up really nicely. You have an enormous base here for this period of time, right? If you take a look at this while we're just waiting for questions, if there aren't any, that's fine. But if you just kind of take a look at that level right here, and then you just go from here and just look at the size of that base. Okay, you're like 6 months, and now you're flipping it. So, hey, Tony, is it better to combine the trend line breaks with the M&A cross for a high probability trade? Yeah, absolutely. So if you are overlaying more than one indicator in a trade, it's a great question, Tony. So let's go through this and get rid of everything here. So if you are overlaying different pattern recognition with a trade, like trend line breaks or things along those lines, it definitely will matter. It will definitely make a difference. So if you go and take a look at something like, let's get rid of this and let's put these in. And I'm just going to use Tesla because it's just where we've been all day. So let's get rid of all these annotations. Close this. So we're going to leave our lines in, right? So here's your cross, right? Let me get that arrow. So here's your cross here. And here's your cross here. So I did not add to this yet on Friday for a real long-term position, right? We had some levels. We've been in trading this for a while, but there were spots here that you probably could have added, but it just didn't make sense to yet. Why? Because I don't really have that breakout. I actually had it at the end of the day. But if you take a look at like this particular level, okay, and you can see very clear when that happened, right? So now you have your signal. Okay. Now this isn't going to be a trend line, but it's going to be a pattern, right? Once you get above that wick and get right here, that was it. It was on. Okay. So you could have used this as a signal and said, okay, now that I have a signal, I'm going to wait until I have some kind of pattern. Now you could have said, I'm going to use this little doji right here and try, right? But that's, you're kind of scalping a little bit into an 8-day. You might not do that, But when you flip this and you flip this huge flag right there, Tony, like, look, when you flip that flag that's right in there, I'll just highlight the flag. Okay. And then you pop over it. That's exactly what you're looking for. Okay. So there you are. You're breaking out of the flag and you're pushing, and that's your level right there. Right. So yes, it works with trend lines. It works with pattern recognition, whether you're breaking through support and resistance lines. If you have more than one indicator that you're utilizing and they line up, absolutely it helps you. There's no question about it. So hopefully that's helpful.